Hello, this is John Eade. I am the president and director of portfolio strategies of Argus Research Company. Argus is an independent research firm based in the US and London, and we make forecasts for global economies, global markets, different sectors, and buy hold ratings on 500 leading global companies. Today, I want to talk about a topic that a lot of our clients are asking me about, and that's about value investing. Value investing versus growth investing. Now, this is something that many investors really hadn't considered for the past 10 years because the past 10 years has been a great growth market. You think of all the technology stocks and biotech stocks that have done so well in growth industries, in growth sectors. And you compare that to, say, value-oriented companies like steel companies or energy companies. And those companies have seen capital drawn out of their industries and into growth industries really for 10 years. So growth has been beating value from basically 2010 to 2020. And then late last year, we started to see a shift, and out of favor value sectors have come back into favor and are now leading the market here in the US in 2021. Now, for the long run, we think the growth companies are probably better positioned in portfolios than value companies. After all, our world is going to be driven more by technology advances in the future than it is by a new oil find in some deep sea or through the shale. However, for right now, value is hot. So if you're thinking about adding value to your portfolio, here's some things I think you should consider as you take a look. First of all is defining value. And value can be hard to define. A lot of times investors will look at a PE ratio, and they'll think a low PE ratio is a value stock and a high PE ratio is a growth stock. That's not necessarily the case, though. Maybe a PE ratio is high because earnings are very low and it's actually a value company in a value industry that just isn't earning any money. So I toss out PE. I also toss out dividend yield. Typically, a high yield signals value, but a high yield may also signal that the dividend is about to be cut and the stock might take a hit. So I throw out dividend yield too. What I like to look at is a price to sales ratio. Almost every company has sales, and the higher the price to sales ratio signifies a growth company, and the lower price to sales ratio signals a value company. If you look at our benchmark here in the US, the S&P 500 price to sales ratio is 2.6. So I'm going to call a value stock anything with a price to sales ratio of below 2.6. But once I've identified these value stocks, then how do I pick among them? If you divide the S&P 500 by that price to sales ratio, you get about 250 value and 250 growth. Well, what I'm going to look for value companies, in addition to the low valuation, is I'm going to look for a dividend. If a company is paying a dividend and the yield isn't too high, generally that company has a good balance sheet and a high degree of financial strength. A lot of times when you shop for value, you may fall into a value trap because a company keeps stumbling, the industry is too hard to overcome. But if a company is value priced and has a dividend, that's going to be a good signal for me. I'll also try to take a look at the balance sheet. And I don't want to see too much debt because a lot of times, again, these value companies, their margins are thin. They don't generate a lot of cash. We wanted them to use the cash to pay the dividend and not have to worry about missing out on interest expense. So value investing is a trend here in the US right now. It may not be forever. There are some opportunities left in value. And when you're looking for value, I would focus on price to sales ratios with companies that have a dividend yield of maybe 2, 3, or 4%, nothing higher, and low debt on their balance sheet. Thank you very much.